Hey, what's up, YouTube fam? GMAC. We're going to go over the first two episodes of the 2022 mentorship. Basically, the goal of this is to kind of summarize it. The best way is to go watch it yourself and go to the Skool classroom, the thread, and if you have any questions, post your questions in there and just get a group discussion going. The terminology through the first two episodes is you need to set up a demo. If you don't know what that is, you can go to TradingView or any platform and set up a paper trading account. One handle in the NQ or S&P has 4 ticks for one contract. NQ is $20 and S&P is 50. Micro is 1/10 of that. That's what I suggest you start with is micros. So NQ would be $2 per point or 50 cents per tick instead of $5 and $12.50 respectively. S&P would be $5 per point and $1.25 per tick. You need to know what a fair value gap is. We'll go into that. That's a 3 candle formation. A lot of people get it wrong. They go from wick to wick. It's actually body to body. Um, Seasonal tendencies is how the market reacts during the certain time of the year that we're in. Um, an imbalance, what an imbalance is, that is the 3 candle formation, but that is wick to wick where price hasn't went through, which we'll show examples of that. And what liquidity is, what buy stops are, what sell stops are, what a stop hunt is, and we're going to go into that now. So basically, ICT starts off. He always asks you to go into the charts and see it for yourself. Never take somebody's word. If you're watching somebody or listening to somebody, after you take your notes or whatever, go into the charts and find it yourself. He mentions this mentorship is for his daughter. He's stripping it all the way down so anyone can use it. It's geared towards the newer person. He calls them greenhorns. You can trade any market with this approach, but he focuses on the indices, specifically NQ and ES, and you can use it on any time frame. He promises to show you that this repeats a lot. It repeats um, mostly every day and especially every week. And he says there's 3 phases from it that right now you're yearning, like you're meaning you're wanting to be a profitable trader. You're eat up with the idea of being a profitable trader and being able to do this. And he wants you to go from that to be a learner, not to rush, to learn the process, to take in the information, to take notes, to back test, to go back through old data and find these moves, and eventually to where we all want to be is to make to be an earner, to make a consistent living from trading. He emphasizes starting with the demo, and he wants you to be independent. Yeah, it's okay to learn from people, but eventually wants you to take this information and be independent. Like you don't need him, you don't need me, you don't need anybody. You just need yourself and the chart after you've learned everything. He emphasizes not to shortcut things or your results will suffer. So go and do the homework, do the back testing, go back through the old data, annotate your charts, whatever that you want to do, and make sure that you are doing that on a consistent basis. That if you do rush and you have the mindset that you've got to hurry up and rush, that you're going to leave stuff out, that's a terrible mindset to have. And believe me, I know because I've done this. And he don't want you to quit. Just stick it out. So that was basically the introduction. Episode 2 is called Elements to a Trade Setup. He operates off TradingView and a paper trading demo for his protection. Um, Basically goes over how NQ and ES and the Dow move in line with each other. but NQ moves faster, so he likes NQ. He starts in a top-down analysis. He goes from the weekly chart, basically trying to get bias. Start at the weekly and go to the daily. What is the weekly reaching for? What is the daily reaching for? And then try to key your trades, in that level or in that direction. Um, and to do that, basically, when he's on the weekly and daily chart, he's going over seasonal tendencies. So, like right now, December, basically, especially after election cycle, we usually see a positive return in December, meaning we're bullish this time of year. So that's seasonal tendency. Are we bullish or bearish this type of year? Then he goes over interest rate scenario. Are we trying to cut rates? Is the Fed cutting rates or going higher? They've been trying to cut rates, so that's another bullish scenario. So we're stacking bullish things, seasonal tendency, then the interest rates. So he's trying to draw your attention to where is price drawing to on a higher time frame. Is it clear to you? And if it is, then you want to trade in that direction for the highest probability. For this specific model, he's wanting you to look for swing highs and swing lows on a daily chart or a higher time frame chart than what you're trading to look for pools of liquidity to trade into. He emphasizes spending most of your time on the daily chart, considering that big hedge funds, banks, institutions, big players in the game are looking at the daily chart. And this is the fingerprints to the setup. We're going to go over his chart here, and basically what he's outlined here is he's got buy side up here and sell side down here. These were a bunch of equal highs and a bunch of equal lows. So what he's drawing your attention to is what I like to do, and what he suggests as well, is the levels that I like to have is the last week's high and low, the previous daily high and low, and the previous session's high and low. So like a Asia London high and lows, last week's high and lows, and the previous day high and low. So he's taking your attention right here at time then price. So what he's showing here is buy side is getting took out, and we create what you have. If we're going to be bearish, we want to see a swing low broken. So after taking buy side, we create a swing low, okay, and then we violate that swing low. And then what do you leave behind? This is the 3 candle formation. 1, 2, 3. This is the fair value gap. In this model, this going up is this entry. He emphasizes that it's hard when you're bearish to take a sell as you're going up, because you're taking a short. You want the market to go down, but you have to get used to when it's trading up into the fair value gap is when you take your entry. So this is a 2-minute chart. We've done our homework. The higher time frame suggests that the buy side's up here, sell side's down here. I mean, you could have done this. You took sell side, and we have a swing high right here. And he didn't go over this. This is just both ways. This swing high gets violated with displacement. We leave behind a fair value gap. 1, 2, 3. We enter here and target buy side. That's the same thing. And this is the actual institutional order flow entry drill, and all that means in simple terms is this 3 candle formation is the fair value gap. The next candle that drops down into it, or the candle after the fair value gap drops down into it, is institutional order flow entry drill. Your entry would be here. Your stop could be below this candle, or if you're super safe, is the first candle. 1, 2, 3, you're in it, targeting buy side. The one he shows is the sell side model. Is we've broke buy side here, we created a swing low, we violated that swing low, and what did we leave behind? We left behind a fair value gap. 1, 2, 3. Those are the three candles: green, black, green. And from body to body is the fair value gap. So what you're waiting on is, as this candle is going up into the gap, that's where you want to sell short. Okay, you want to put your stop above at least this candle's high or the first candle, whatever your risk parameters allow. And what do you target? So you want to define the dealing range, and all the dealing range is where did we take sell side and where did we take buy side at that price leg. So from here all the way up here is our dealing range. So if we're selling short, we'll put our fib from this wick up here all the way down here. Okay, and all the settings on your fib need to be is the midpoint. You have one, I think it's 0.5 for the midpoint, and -1. So the way you could target is the market's moved from premium to discount. When we're selling, up here is a premium, down here is a discount. Since we're in a premium and we're selling, it's going to move to a discount. So you'd put your fib from here all the way to here and find the midpoint. And just below on this is right here, these equal lows is in a discount. And just under that is an imbalance. From there to that wick is an imbalance. So that's what I would be targeting, is that right there, and that's what he's showing. So we're breaking buy side. Okay, we still can't just take a trade because we took buy side. We have to create a swing low. Okay, we did. Next step is displace below the swing low. What I mean by displace is energetic push down, not just a little bit and then go back up. We have to, we're going through it. So we did. We went through this swing low with force, leaving behind a fair value gap. That's our entry, and our target would be a fib from here to here. Find the midpoint, and somewhere at the midpoint or below, because it's going from a premium to a discount. And in this case, we have equal lows here with an imbalance just below it. That is just beautiful. So if you have any questions, post on the YouTube or the Skool thread. That's the first two videos getting you started. That gives you the model. It gives you something to go look at in the charts. My suggestions to you would be to go back in your chart, put your higher time frame lines on here, like last week's high and low, previous day high and low, previous session's high and low, and watch after we break those levels, drop down to a 1, 2, 3, 4, or 5 minute time frame, whichever you feel comfortable with, and watch how it reacts, and watch how this plays out over and over on a weekly and a daily basis. I'm doing my best. I hope this helps you, and I appreciate y'all very much. Have a good day, and more to come.